Hello, I'm Robert C. Baker with Zach Taylor Chattanooga and Move to Chattanooga. In this video, we're diving into several significant economic developments that could directly impact your real estate decisions. We'll explore President Trump's new tariffs, the recent stock market sell-off, the latest employment figures, potential moves by the Federal Reserve, and how these factors are influencing mortgage rates. Let's break it all down. On April the 5th, the United States implemented a sweeping 10% baseline tariff on all imports, marking a significant shift in trade policy. Additional tariffs are set to take effect within the week. European Union imports face a 20% tariff, and Chinese goods will be subjected to a 34% tariff, bringing the total levies on China to 54%. In response, China announced retaliatory measures, including extra levies of 34% on all U.S. goods and export curbs on certain rare earth minerals. While the administration argues that these tariffs will bolster domestic manufacturing and reduce trade deficits, critics warn of potential inflationary effects and disruptions to global supply chains. The increased cost of imported goods could lead to higher prices for consumers, affecting a wide range of products from electronics to automobiles. The announcement of these tariffs has had an immediate and profound impact on the stock market. On April 4, the Dow Jones Industrial Average plunged 2,200 points, or 5.5%, marking its worst performance since the early days of the COVID-19 pandemic. This followed the previous day's 1,600-point decline, achieving a grim milestone of losing more than 1,500 points 2 days in a row. The S&P 500 also experienced significant losses, dropping 2.9% in early trading. The Nasdaq Composite tumbled 5.8%, pulling it more than 20% below its record set in December, potentially signaling a bear market should the trade war continue. These sharp declines have directly impacted 401ks and individual stock portfolios, leading to substantial paper losses for investors and retirees. The volatility underscores the market's sensitivity to trade policies and highlights the importance of diversification and risk management in investment strategies. Amidst the market turbulence, there is a silver lining. The latest employment report, released in early April, shows that the U.S. economy added 228,000 jobs in March, significantly exceeding expectations. On the other hand, the unemployment rate edged up slightly to 4.2% in March from 4.1%. Nevertheless, economists view the uptick in job gains as a positive indicator, reflecting a potentially improving labor market with more people optimistic about job prospects. However, they caution that the newly imposed tariffs could slow hiring and elevate unemployment in the coming months. The Federal Reserve is closely monitoring these economic indicators. While the strong job growth report suggests a robust economy, the new tariffs introduce uncertainty. Market predictions indicate an increased chance of interest rate cuts by June 2025, with traders anticipating short-term rates to fall below the current range of 4.25% to 4.5%. However, some analysts predict that the Fed may adopt a cautious approach, potentially delaying rate cuts to better assess the tariffs' impact on the economy. The ongoing trade tensions and potential inflation from tariffs add complexity to the Fed's decision-making process. Following the tariff announcements, investors have shown increased concern about economic stability, leading them to seek safer investments like U.S. Treasuries. On April 4, this surge in demand caused the yield on the 10-year Treasury note to fall briefly below 4% for the first time since October, suggesting increased fears of a recession. The decline in Treasury yields is significant because it influences other interest rates, including those for mortgages. Lower yields often lead to lower borrowing costs, which can stimulate economic activity, but also indicate investor caution about future growth. In response to the fluctuations in Treasury yields, the average 30-year fixed mortgage rate has experienced a slight downward trend. As of April 4, the rate stood at 6.6%, down from 6.76% the previous week. FHA and VA loans, which run about 0.5% below conventional, fell to 6.03% and 6.05% respectively. While this decrease presents potential opportunities for home buyers, it's essential to stay informed. The ongoing trade tensions and potential inflation from tariffs could lead to future rate volatility. Additionally, forecasts suggest that mortgage rates may fluctuate in the coming months, influenced by economic developments and Federal Reserve decisions. So, what does all this mean for real estate here in the greater Chattanooga, Tennessee area? For buyers, the current dip in mortgage rates could make this an opportune time to secure favorable financing by locking in a lower rate. However, be mindful that tariffs may lead to increased prices for imported construction materials, potentially raising new construction home prices in the future. Acting sooner rather than later might be advantageous. For sellers, a robust job market may lead to greater consumer confidence, which could be a positive for housing demand. Yet, keep an eye on how tariffs might influence buyer purchasing power and overall market sentiment. Pricing your home competitively and being prepared for potential shifts in buyer behavior will be key. Navigating the real estate market amid these economic shifts can be complex. Staying informed about broader economic policies like the recent tariffs and their ripple effects on employment, interest rates, and mortgage rates is crucial. If you're considering buying or selling in the greater Chattanooga, Tennessee area, feel free to reach out. I'm here to help you make sense of these developments and guide you toward informed decisions that will be a net positive for your bottom line.